Wall Street falling for a second straight day Monday amid rising tensions between the United States and Iran. But they seem to be sort of whittling away at the losses at the start of the markets near the flat line. So what to make to this bumpy start to this new year? Let's ask Andy Wang. He is a certified financial planner, a wealth manager, as well as the host of a podcast called Inspired Money. Welcome back and Happy New Year, Andy.
Thank you.
So should investors be inspired to take your word by what they're seeing on the first few trading days of this year? Or what do you make of this, sort of modest reaction to this, what happened is an airstrike in Iraq?
Well, welcome 2020. It's bound to be interesting, right? In just a couple of days. It's not going to be boring. I mean, the targeted bombing that killed Soleimani definitely sharpening an issue that it's a very sensitive area already. It's a tumultuous area, and now that is escalating. So a very muted reaction, as you observe, and I think that that's a positive. I think that barring any major geopolitical event, that investors should be focused on earnings, the economy, and really what the central banks are doing.
So should investors use those declines as a reason to buy instead of bail?
Well, everybody's wondering because of the duration of this bull market. Many people are sensitive. And I know that clients and investors alike are asking the question, is war good for the financial markets? And if we look at recent history, financial markets have been extremely resilient. And I think that really goes back to the size and scope of these conflicts. As long as they're lopsided and short in duration, the financial markets don't mind. If you go further back and you look at more major events like World War I, World War II, then it's not as good for investors.
So stay invested for now.
Stay invested for now.
And pick up on declines? Or would you wait for a big one?
I think it's okay. And again, I said earnings, the economy, and the Federal Reserve. I think that those are the three major factors for investors to be looking at. And if we look at just one, the central banks, the Fed started injecting liquidity into the system and is currently at a rate of $60 billion per month. And at that rate, by June, we'll see a Federal Reserve balance sheet that will be a new high.
And Andy, would you be making any asset reallocations at this point?
I tend to feel like, it is a good time to stick to your plan, right? There continues to be a wall of worry. We saw that throughout 2019. People were worried about Chinese tariffs and the trade war and a lot of activity happening in Washington. None of that has gone away. That continues today, and now we have the Middle East. So we saw WTI spike to $70 today. We see gold prices hitting 7-year highs. Things are dynamic and changing. But I think that as long as investors have a plan and a roadmap, they should stick to that and follow that.
And since you mentioned Chinese tariffs, let's finally go to one of your stock picks, which is JD.com. Of course, it's often seen as the arch rival of Alibaba. Why that stock? It's already appreciated quite a bit last year, up 70%, if I remember, 70% over a 12-month period.
Yeah, that is a big move. I think that the story there is that the size of the retail market overtook the U.S. last summer. And it's a $6.2 trillion market. The other big number that I like is that there are 400 million millennials in China. That is larger than the US and European workforce combined. So this is an area that we cannot ignore. And I think that investors would be smart to have some exposure to the Chinese consumer.
And don't worry about the trade conflicts, because at one point, I remember the Chinese stocks were under pressure last year.
Last year, especially, mid-year in particular, I think that, yes, you always see, like, they say that the baby was thrown out with the bathwater. I think that the key here is that there's a big difference between the manufacturing sector, which is feeling the effects of the tariffs and trade war, versus the consumer, because there you're having rising wages and citizens are spending more on electronics, food, consumer goods, entertainment. And we feel like the e-commerce space is a really good area to be in.
All right. 400 million millennials. Huh?
400 million millennials.
All right, and counting. Thanks a lot, Andy. Our thanks to Andy Wang of Runnymede Capital Management. I'm Fred Katayama, and this is Reuters.